Imagine spending $500 million on a floating city, only to realize you're essentially running a high-stakes, hyper-complex game of logistics where one bad week can move the needle from record-breaking profits to a logistical nightmare. Everyone loves the dream of the open ocean and the allure of a seamless vacation. But what you don't see, what the brochures conveniently hide, is the sheer, breathtaking brilliance of the industry's economic machine. These vessels are far more than just luxury vacation destinations. They are marvels of financial engineering, logistical perfection, and global commerce that operate at a scale almost impossible to fathom. From the sophisticated revenue management systems that maximize every square foot of deck space, to the incredible, record-breaking efficiency of their supply chains, the cruise business model is a masterpiece of modern enterprise. It is a world where extreme ambition meets near-impossible engineering, resulting in a unique form of prosperity that defies conventional logic. Whether you view them as the ultimate high-risk gamble or as the pinnacle of hospitality innovation, there is no denying that owning one is the most intense, rewarding, and transformative challenge in the travel industry. Today, we are diving deep into the massive, high-stakes engine that powers these titans, exploring why they are both a logistical challenge that borders on insanity and a goldmine that consistently captures the world's imagination. To understand the economics of a cruise ship, you have to stop thinking of it as a boat and start thinking of it as a high-frequency, captive market city. When a vessel like the Icon of the Seas leaves port, it is carrying up to 7,000 guests and 2,000 crew members. That is a mid-sized town moving at 22 knots. The sheer scale of this operation is why the industry is so incredibly lucrative, yet so intensely complex. The genius of the cruise model lies in its ability to turn every square inch of steel into a revenue-generating asset. This is built on a two-pillar economic foundation: the ticket price and the onboard spend. For years, the industry operated on the get them on board strategy. Cruise lines often price tickets to cover little more than the variable cost of food and housekeeping. They aren't looking to get rich on your cabin fare. They are looking to get you past the gangway. Once you are on the ship, you have entered a perfectly optimized consumer environment. The transition from a transit-focused shipping line to a destination-focused resort model is the most important pivot in the history of the cruise industry. In the mid-20th century, cruise ships were a means to an end, a way to cross the Atlantic or the Pacific. Today, the ship is the destination itself. This shift required a complete restructuring of the vessel's interior architecture. Architects began prioritizing public spaces, atria, theaters, casinos, and expansive pool decks over cargo hold space. This is a massive trade-off. By sacrificing the ability to carry freight, cruise lines leaned into the experiential economy. They realized that the customer is willing to pay a premium not just for a bed, but for an environment that feels disconnected from the mundane stresses of land-based life. This is why the mega-ship trend accelerated so rapidly. The more square footage you have, the more anchor attractions you can install: water parks, surf simulators, Broadway-style stages, and high-end specialty restaurants. Each of these is a dedicated revenue stream, designed to keep the guest from ever feeling the need to leave the ship. Once the ship leaves the harbor, it becomes a closed economy. Every drink, specialty dining reservation, excursion, spa treatment, and casino chip is a high-margin transaction. In the industry, we call this net yield. Cruise lines use sophisticated data analytics to track passenger spending patterns in real time. If they notice the demand for high-end cocktails or private cabanas is trending upward, they can adjust the pricing algorithms for those services within hours. They are essentially running the world's most efficient, mobile retail environment, where the customer base is physically unable to go to a competitor to find a better price. The reason this model works isn't just because of high prices. It's because of incredible, bordering on superhuman efficiency. A cruise ship is a massive engine that consumes thousands of tons of fuel. To protect themselves, companies engage in complex fuel hedging, essentially betting on oil prices years in advance to lock in costs and ensure that a spike in energy prices doesn't destroy their margins. Keeping 9,000 people fed, watered, and entertained requires a level of coordination that makes a Fortune 500 company look like a corner store. These ships are stocked with surgical precision. They know exactly how many eggs, how many cases of wine, and how many gallons of fresh water are needed for every single day of the itinerary. They minimize waste to a degree that is frankly revolutionary for the hospitality sector. There is also the matter of space optimization. Every cabin on a ship is a microeconomy. A balcony room commands a higher price than an interior room, not because it costs more to build, but because it captures more consumer surplus. Cruise lines have become masters of variable pricing, shifting the cost of cabins based on time of year, regional demand, and even the demographic profile of their passengers. They treat inventory like an airline treats seat capacity. If a ship isn't full, they would rather fill it with a discount traveler who is likely to spend heavily on drinks and excursions than leave the cabin empty. The marginal cost of an additional passenger is incredibly low once the ship has left the dock, meaning every dollar that passenger spends on board is almost pure profit. These ships are built to last 30 years or more. By constantly renovating and redecking public spaces to keep the product fresh, operators extract maximum value from the multi-billion-dollar capital expenditure of the ship's initial construction. The life cycle of a ship is a masterclass in asset management. They are designed for modularity. If a bar isn't performing, they can swap it out during a scheduled dry dock period. If a specific entertainment trend dies, they can pivot the theater space. This flexibility is what allows these massive assets to remain relevant in a world where consumer tastes change faster than ever. Ultimately, the cruise industry isn't just about vacations, it's about the mastery of recurring revenue. They have managed to create a business where the customer is not only happy to be a captive consumer, but is actively looking for ways to spend more money once they are on board. It is a masterclass in logistics, engineering, and financial engineering, all wrapped up in a 5-star experience. If the revenue machine is the heartbeat of a cruise ship, then the financial structure behind it is the skeletal system. And it is arguably the most controversial part of the business. Building a modern megaship costs upwards of $1.5 to $2 billion. To put that in perspective, you could build a decent-sized skyscraper or fund a mid-budget Hollywood franchise for the same price. How do these companies afford it? They rely on export credit agencies. Because cruise ships are almost exclusively built in a handful of high-tech European shipyards, the governments of those countries provide massive, low-interest loan guarantees to make the deal happen. This essentially means the cruise lines get cheap money to grow their fleets, allowing them to remain profitable even when global interest rates climb. This financing arrangement is the original sin of the cruise industry, according to some economists, who argue that it distorts the market by artificially encouraging the production of larger and larger ships. Without these government guarantees, would we still see ships of this size? Likely not. The economies of scale are only profitable because the barrier to entry is lowered by state-sponsored financial backing. But the real debate, and the source of consistent industry friction, lies in the flag of convenience model. Most cruise ships are registered in countries like Panama, the Bahamas, or Malta, rather than the countries where their headquarters are based. This allows them to bypass many of the rigid labor laws, corporate tax requirements, and safety regulations of the United States or Europe. Proponents argue this is a global necessity. It's the only way to operate a fleet that crosses international borders without getting tangled in a permanent web of conflicting national jurisdictions. Critics, however, see it as a blatant exploit that allows massive corporations to dodge billions in taxes and keep labor costs drastically lower than they would be on land. This creates a fascinating legal paradox, where the ship acts as a piece of sovereign territory, subject to the laws of its registry, not the laws of the country whose ports it visits or the country where its passengers hold citizenship. This jurisdiction hopping is essential to the cruise business model. It allows them to maintain a globalized labor force that can work 10 to 12-hour days, 7 days a week, for contracts that might span 9 or 10 months. This brings us to the most complex and often polarized aspect of the cruise economy: the crew. On a ship, you have two realities coexisting on the same deck. For the guest, it is a world of leisure and indulgence. For the crew, it is a high-pressure, grueling marathon of service. The economics of the industry rely heavily on a globalized workforce. Because these ships operate in international waters, companies can hire from countries where the wages are far higher than the local average, but a fraction of what they would be in the West. This model allows cruise lines to keep their labor costs manageable, which is the only reason your all-inclusive price remains accessible to the middle class. Without this specific labor model, the cost of a cruise would likely double, effectively ending the industry as we know it. It is a system that creates significant economic mobility for thousands of crew members, providing them with a way to support families back home, yet it remains under constant scrutiny for its intense, relentless work hours and the inherent difficulty of living where you work for months at a time. The crew quarters are the unsung, behind-the-scenes engine of the ship. They are small, functional, and efficient, designed to maximize the number of service providers per square foot. The turnover rate in the industry is a constant challenge, but the demand for these jobs remains remarkably high, proving that for many, the trade-off is worth it for the opportunity to send remittances home. Finally, we have to address the elephant in the engine room, the environmental impact. The cruise industry is currently in an arms race to adopt greener technology, such as liquefied natural gas propulsion and advanced waste treatment systems. They are spending billions to pivot toward sustainability, partly out of genuine responsibility, but largely because their business model depends on the allure of pristine, beautiful destinations. If the reefs die or the ports they visit become polluted, the product becomes worthless. It is a bizarre, high-stakes irony. The industry is one of the most efficient modes of travel in terms of per-passenger carbon footprint, yet the absolute scale of these ships means they are still massive emitters. They are trapped in a cycle where they must constantly build bigger, more opulent ships to satisfy customer demand for more, while simultaneously trying to shrink their environmental footprint to stay relevant in a greener world. The technology behind this pivot is truly impressive. We are talking about scrubbers that clean exhaust, advanced waste-to-energy systems that turn food scraps into power, and hull paints designed to reduce drag, thereby saving millions in fuel costs. The economic incentive for green innovation is actually quite strong. When you burn thousands of tons of fuel, a 5% increase in efficiency equates to tens of millions of dollars in savings annually. Therefore, sustainability isn't just about PR, it's about margin expansion. The more efficient the ship, the more profit it generates. This is the hidden side of environmentalism in the cruise industry. It is driven as much by the desire to cut operational costs as it is by the fear of regulatory crackdown. It is a tightrope walk between being a marvel of modern industry and a lightning rod for global criticism. The cruise industry is a master of adaptation, but it is constantly one public outcry, one regulatory shift, or one economic downturn away from being forced to fundamentally change how it operates. The industry has survived global pandemics, financial crashes, and major geopolitical shifts. Each time, it has come back stronger, leaner, and more aggressive in its pursuit of market share. This resilience is a testament to the fact that people desire an escape more than almost any other product in the travel market. There is a profound psychological element to all of this. Why do we keep going back? Why, despite the headlines about labor, the environment, and the corporate complexity, do we keep booking these voyages? It comes down to the promise of frictionless luxury. In our daily lives, we are bombarded by choices, bills, traffic, and the endless mental load of modern existence. A cruise ship is the only place on Earth where you can be effectively off the grid while having every possible need met by a 1,000-person staff. When you step onto that ship, you aren't just buying a room. You are buying a curated reality where the outside world ceases to exist. That is an incredibly potent product. The cruise lines aren't just selling travel, they are selling the feeling of being taken care of at a scale that is almost impossible to replicate on land. This is why the industry is so resilient. Even during global recessions, people prioritize these vacations, because they offer a sense of control and escape that is worth every penny of that onboard spend. However, this resilience doesn't mean the industry isn't aware of its own fragility. The biggest risk to a cruise line isn't an engine failure or a storm. It's a loss of trust. One single public health crisis or one major environmental disaster can do more damage to a company's stock price than a decade of bad planning. This is why they invest so heavily in crisis management and public relations. They are constantly selling the idea that they are bettering themselves, that they are moving toward hybrid electric propulsion, that they are supporting local economies in the Caribbean and the Mediterranean, and that they are providing life-changing opportunities for crew members. And to a large extent, they are. You cannot run a billion-dollar asset into the ground. You have to maintain it, polish it, and keep it running perfectly. The drive for efficiency is what keeps the lights on, but the drive for social and environmental legitimacy is what keeps the business model alive in the 21st century. Looking forward, the next decade will be defined by the decarbonization challenge. If these companies cannot solve the emission issue, they will lose access to the very ports that make their business possible. We are already seeing cities like Amsterdam and Venice implement strict limits on cruise traffic. This forces the companies to innovate or die. We are moving toward a future where ships will be smaller, smarter, and significantly more expensive to operate. But the core of the business, that captive market dynamic, isn't going anywhere. Humans will always want to be near the water, and they will always be willing to pay a premium for a vacation where they don't have to think. The economic future of the cruise ship is likely to involve a greater focus on bespoke experiences. As the megaships reach the limits of what is physically possible, companies are turning towards smaller, ultra-luxury vessels that cater to a different segment of the market. These ships offer higher price points, lower guest-to-crew ratios, and a more authentic experience. This is the hedge against the excess criticism. By diversifying their fleets, the major cruise lines are effectively insulating themselves from a future where mass-market cruising might face heavier taxation or restricted port access. It is a brilliant way to ensure they control both ends of the economic spectrum. In the end, owning a cruise ship is not just about the economics of the balance sheet. It is about the economics of the human experience. It is a strange, paradoxical, and endlessly fascinating industry that manages to bridge the gap between pure industrial-age grit and modern, high-tech hospitality. It is a world of billionaires, labor migrants, environmentalists, and dreamers, all navigating the same waves. Whether you find the industry to be a masterpiece of economic ingenuity or a massive floating monument to excess, one thing is certain: as long as the ships keep sailing, they will continue to serve as the ultimate test of our ability to balance profit, people, and the planet. The next time you walk onto a ship, look past the buffet, past the pool, and past the neon lights. Look at the logistics, the fuel, the thousands of people working behind the scenes, and the billions of dollars of engineering under your feet. You aren't just on a vacation. You are in the middle of a massive, moving economic experiment, and you are the final piece of the puzzle. The ship relies on you, the guest, to complete the circuit, to pay for the upgrade, to book the excursion, and to buy that extra drink. You are not just a passenger. You are a vital contributor to one of the most resilient and most controversial economic engines ever built. The economics of the cruise industry is the economics of us, our desires, our escapism, and our relentless demand for more. As the industry continues to evolve, it will continue to reflect our own priorities, our own flaws, and our own capacity for innovation. The future of the cruise ship is our future, written in water and steel.